So many different places to start. And I do want to talk about the 60-40 portfolio. President Trump, we watch and what he's doing with policies. We talk about AI a lot. We're going to get into that. The Fed. Do you just look at it all, or like first thing in the morning? What do you want? Do you want to check what's going on in Asia? Is it everything that is a priority right now?
Yeah, no, absolutely. I mean, the agenda is certainly first, Iran is very important. Are ships going to sail through the Strait of Hormuz or not? How much oil is going to get delivered? That continues to be a very important risk, because if we do run dry in tanks, especially in Europe, then we may run out of marine fuel, of jet fuel, of fertilizer, of helium. And obviously this creates a jump risk in prices, especially for energy.
That's still a risk, even though they're back and forth. And
I know.
It looks like markets look through it.
You're right, Carol, because this hasn't been an issue for a while because we've been so busy with the Fed and with AI. But in the background, this continues, unfortunately, to still be very, very important, because it literally is the case that we could have some tanks get to critical levels. Yes, there's still, of course, fuel running in the pipes and the systems have to function, but we don't know what that critical level of inventory is. And the risk is when we don't have 20% of oil that's supposed to be delivered every day coming through the Strait of Hormuz or Bab el-Mandeb, the consequence is that we still have this in the background as, again, jump risk in oil prices in particular, and also for agricultural prices. So yes, this just adds to the other things about Walsh's press conference and AI and all the other things we can talk about.
But one more on oil and Iran before we get there. It does seem like the oil market, and we just heard from Jeff Mason, who said we have no idea what the talks are happening between the U.S. and Iran right now to end this conflict. Oil prices, though, are down 5%, whether we're talking Brent or WTI. Is the oil market getting this right, or is it getting it wrong?
Well, it is quite remarkable that oil prices have been through this roller coaster of going up and down and seems to have a much stronger opinion about whether a deal is happening or not.
Yeah, it does.
Whereas people in rates and in the economics and in the region, they have a much more nuanced view of, hey, if there is no sign of a deal, and if we have a deal, then there is a bigger risk that we could eventually run dry. So that's why the clock is truly ticking on oil inventories. And the more that ticks, the higher is the risk. Remember, this is now 2 months ago that the head of the EIA said that we were 6 weeks away from Europe running out of jet fuel. Mm-hmm. Now, we thankfully have not reached that point quite yet, but it's very clear that we literally have 0 ships. If I look at my Bloomberg screen, Ecan Hormuz, 0 ships coming through the Strait of Hormuz and Bab el-Mandeb at the moment. That is still a very significant risk in the background. It's difficult to quantify. Who knows if this is tomorrow, next week, or next month. But if the Iranians continue with this until the midterm election, I feel very confident that then we will have the risk that we could see inventory. Remember, Nice Airport ran out of jet fuel 3 weeks ago.
Yep.
So this is also not just some academic exercise. This is something that's really truly happening, not only for jet fuel, also for marine fuel, other types of fuel, and of course also agricultural products such as fertilizer and helium.
Maybe this is why Fed Chair Kevin Warsh was so general, broad, macro. And I want to play something for you because Double Line Capital's Jeff Goodlock called out Michael McKee on X, noting that Mike's question at last week's FOMC press conference. He wrote, the greatest financial media moment year to date was Michael McKee teeing up and then delivering what are you waiting for to Fed Chair Warsh. Listen up, everybody. Here's what Mike had to say at the FOMC press conference last week.
What vetting did you do of the people that you appointed to the task forces? In particular, given Mark Andreessen's substantial political spending, $25 million in just the past year to back candidates who oppose stricter AI regulation, how can the public be confident that a committee he co-chairs will provide an independent assessment of AI's economic effects rather than one aligned with the interests of the AI industry?
Yeah, so I selected 15 incredible subject matter experts to tackle 5 of the most important questions that if we get the answers right, we're going to do a far better job in delivering. And if we get the answers wrong, we have a problem. The comfort that I can give you and your listeners is...
All right, we're going to get out of that. That was actually not the soundbite we wanted to play, but that was Kevin Warsh with Michael McKee. But Mike was basically saying, what are you waiting for? And Torsten, you obviously watched it. He just was so general macro. What did you take away from Kevin Warsh last week?
Well, I think the market reaction speaks to Mike's question, namely, what are we waiting for? Why didn't you just hike rates? The fact that they didn't do that, and the market reaction with a very, very steep curve, of course, said you should have hiked rates. At least now we're beginning to ask questions in markets about, well, do you have the commitment to raise rates? Do you really think inflation will be 2%? And if you think so, what is the road to getting to 2%? Are you going to use the balance sheet? Are you going to use the Fed funds rate? Are you going to use tighter financial conditions?
He's should be able to answer, shouldn't he?
He did talk about tighter financial conditions, which may have added a bit to the confusion because it becomes really, really important for the yield curve. Whether you pick to do this through stronger balance sheet, meaning lower balance sheet, whether you do this through higher rates or whether you do this through tighter financial conditions. Because if you trade rates, you, of course, will have a strong view on how is it that the Fed is going to achieve the 2% goal. And you could say, in theory, that we want to do this through a smaller balance sheet, but we didn't even get an answer to that. So that's why people are now beginning to wonder, okay, there's more volatility in markets, we have a steeper curve, more questions being asked. So therefore, if they don't hike in September, of course, then the market will just ask even more questions about, well, what is now the plan?
Can you do it through fewer meetings a year?
Well, that's one way, of course, of doing it, but that doesn't change the facts that the market.
I'm referring to the New York Times reporting on Friday night that
I saw that.
Yeah, that the Fed could have fewer meetings.
Yeah, absolutely, and I think that of course would change the game quite significantly if they were to go to the legally mandated only 4 meetings a year. But it's very clear still that even that debate, the market will still try to price the Fed at every single moment in time, and that basically means that we have a situation where the market constantly needs to think about how might the Fed interpret the incoming data.
Right, go.
Well, I guess does it mean that we hear more from the Fed speakers and they're sort of jawboning between meetings? I'm just trying to understand a world we live in with less communication if you want the market to serve as sort of the benchmark for the Fed. I don't know.
I think the toothpaste will come out one way or the other. Meaning other FOMC members will begin to have speeches where they say, here's what I think. Right. And normally some of these FOMC members, they don't get a lot of weight as such from financial markets. But today they are given a lot of weight because if the chair has decided to say, I'm not giving not even forward guidance, but also not framework guidance, then of course others who are willing to talk about not even framework guidance and forward guidance, but just give a description of the data and talk about how do they think the data could be evolving. I think that is going to get a lot more weight, which is why when Beth Hammack put something on LinkedIn on a Sunday afternoon, this suddenly gets people send this to me all Sunday evening and say, what do you think? How should we think about this? And this suddenly becomes really, really important because the market is constantly trying to figure out what is the trajectory of where rates are going.
Right, exactly. I want to get to the 60-40 portfolio that we've talked about forever, right? Being broken. Why so? And you have an AI aspect to this.
Yeah, so the really important aspect of this discussion is the following. The 60-40 portfolio was really truly a stroke of genius when it was invented. Because remember, if my stocks go up, normally my bond prices go down. That means interest rates go down. And that means I make money on stocks and I may lose something on my bonds. Vice versa, when the stock market goes down, then bond prices go up and other yields go down. And that means, of course, that I make money either on bonds or make money in equities. Somewhat randomly, then pick 60-40. This was the weights, and it made sense in an environment where the business cycle goes up and down. Sometimes I should have in stocks, sometimes I should be having a rates. So if that's the case, this was a very good way to balance your portfolio. The problem today is the following. Namely, today's stocks are really driven by AI. It's not driven so much by the business cycle, and it's highly concentrated with the 10 biggest stocks making up 40% of the basket. So that means that the AI story has become absolutely critical as a driver of the stock market. And the fiscal situation has become a very important driver of the bond market because now we have significant fiscal problems. We have the fact that rates have been going up, the term premium has been going up, and therefore that's also not necessarily a function of what the business cycle is doing. So suddenly you have two new factors that have been a key driver of equities, namely AI, and a key driver of bond markets, namely fiscal, which are not a function of whether the economy goes up and down. And therefore, we may no longer have the property that you make money on one side and lose on the other, but you may actually lose on both.
We've often said, and we've said that when you see the markets like both stocks and bonds going up in tandem, which is just unusual, right, to see that in any given trade. Having said that, big tech, Torsten, has been disproportionately moving the market even before we started talking a lot about AI. Is there something different? Is AI, though, that trade on steroids and even further disconnecting us from the business cycle?
Yeah, let's think about that exactly at this moment in the 60-40 context, because AI, of course, is highly concentrated in equities, so AI better work out, otherwise equities will not go up. So if at the same time AI companies are also issuing a lot of debt, that takes money out of treasury markets into buy hyperscaler debt. So in that sense, even the bond side of my portfolio is also being impacted, and by the way, is also now AI. So suddenly I have AI everywhere in equities. I also have AI in investment grade credit, and by the way, venture capital, 87% is also AI. So now my whole pie chart is actually all AI. So suddenly there's one factor driving driving everything I'm doing. And if there's one thing we learned in finance, is factor investing. And one factor is driving all returns at the moment, namely AI is in equities, AI is in everywhere in public credit, and AI is also in venture capital. So the best recommendation today is to be not in AI, because that gets you away from this one factor that is driving markets at the moment.
You did say in your note, the real risk emerges if the AI trade reverses or markets become more worried about government deficits. In either scenario, both stocks and bonds would face pressure simultaneously, leaving investors with no hedge, which is what you basically said.
Yep.
What happened with situational awareness, the hedge fund? Is that a sign to you of the AI trade reversing? Like, what's your read on that? And I have no idea if Apollo was interested in the assets. Share what you'd like.
Yeah.
But is that the beginning of a little canary in the coal mine?
Well, what
here?
was, of course, very unusual about this is that it didn't take much decline in the AI trade, and suddenly there was a blow up. It was a bit of a coincidence that this was the specific fund you mentioned, but it's very clear that the AI trade reversing. There's a lot of levered ETFs at the moment. There's a lot of people that are having levered bets on AI can only go one way, namely up. And we're now finding out with the underperformings of growth for the last 4 months is very, very substantial. Value has been outperforming.
Yeah.
That's exactly telling you that in a 60-40 framework, growth is just becoming more risky simply because the AI story is beginning to also become more vulnerable, especially with this debate about open source models relative to closed source models. If the Chinese models come and dominate, that will then, of course, take market share from the closed source models. And the question is, how big is that eating into the market share going to be?
The narrative has changed a lot from where we were 3 years ago.